And good morning. I'll have my good morning to everybody else's. Nice to have you here, and obviously things have gotten a little more heated in the securities markets in the last day or two, and so I'm going to take a half step aside for a couple of minutes and just talk a little bit about what we've seen, because I think it's so significant and important. So Steve, if you would put up that first slide. You don't have this in your book, I don't believe, because this is from yesterday. Starting at the left side of, this is what I have on my computer, but it's an awful lot clearer on my computer than you're seeing it here. But starting at about here, this is a 1-minute graph of the Standard & Poor's 500 ETF, which is the SPDR, SPY. And so you can see what happened for minute by minute through the day, through the end of the market day. The day yesterday began with stocks around a little under the 10,900 level on the Dow Industrials. Excuse me, I said this is the SPDR. This is not. This is the Dow, because I wanted to show levels that most people are more familiar with. So this really starts about 2 hours into the market day, and it shows minute by minute how things progressed. It started a little under 10,900, progressed through about here or so with, it doesn't look like a big decline, but it turned out to be about 200 points to that point. So it was a fairly significant decline on growing volume. There was fairly significant volume that came in, far more than we have been experiencing over the past several months at the very least. But the excitement kind of came in here and here. And we saw, and there are going to be a lot of investigations as to what the heck went on, but we saw from about 200 points down, we had a little bit of a rally here for about 5 minutes. That little bit was about 75 points on the Dow. I mean, it kind of pales into insignificance when you see it in this broader context. But then from here to here, we dropped about, I'd say 750 points in about 20 minutes. And over 550 of those points were in approximately 5 minutes. When you get right into the tick, 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 tick down here, it was quite fascinating to sit there and watch it. And it happened so fast. I mean, here you have, from roughly in here, you had maybe 8% of the value of the Dow Jones Industrials, and by extension, essentially the New York Stock Exchange and related markets, about 8-9% or so disappeared in a matter of 20 minutes. That's quite a remarkable phenomenon. And then, interestingly enough, in a very short period of time, approximately 11 minutes, we saw about 600-point gain in the Dow Industrials. The day ended up, first of all, it closed about 630 points above the low, and about just under 350 points below the prior day's close. So if it stood alone and we didn't know how it got from here to here, you'd say, wow, that's a pretty horrible day. But we've seen that kind of thing before. What, of course, makes it unique, and what makes it the biggest price move ever, I'm talking about absolute points now, I'm not talking about percentages, because there have been bigger percentage moves than this. But this, we're almost 1,000 points down, and in recovery to the highs, maybe 700 points up. That's a heck of a turnaround in just one day. And we're hearing competing forces speaking this morning, the people representing the New York Stock Exchange, people representing NASDAQ and so on, and they're arguing over who failed and what went wrong and all this sort of stuff. And no doubt there are going to be a number of investigations, because there were some truly remarkable price movements in there. And we, as most of you who are clients know, we've not been we've not been very enthusiastic about common stock ownership, but we did buy a few stocks yesterday in the decline. Nothing of any great consequence, but they just hit levels that we had been looking for, and so we ended up buying a few. It's not a market commentary, it's really just stock by stock what we were doing. So we will hear a great deal more about this as the days go by, there's no question. Before yesterday, though, and Steve, you can turn to what in your books is your first page, I think. The general public, the mood had turned quite substantially to a positive feeling from what we had been experiencing over the past year and a half, and so on. And I've just profiled a number of headlines which are pretty bullish, and they show that the news media are upbeat, but they're not alone. The securities analysts are almost invariably bullish. Now, a couple might have taken a half step back or two today, but at least prior to yesterday, they were almost universally on the bullish side. And the stock market has obviously surged over the 14 months or so since the March 2009 lows. And this is, I had said earlier, it was spiders. I usually keep the spiders as the picture on my screen just because it's the most representative that I think of the broader market. So in any case, this is the spiders, the exchange-traded fund that replicates the movements of the Standard & Poor's 500. It's a weekly graph, and it goes back to about 2005, going all the way up to the peak in 2007, the big crash down to the March 2009, and then the very strong 14-month rally that we've seen since that time. Notwithstanding that media and professional confidence that I alluded to on the prior page, there hasn't been a great deal of confidence in stocks exhibited by the individual investor. They have essentially departed heavily from money market funds because money market funds, essentially by the Federal Reserve's approach to dropping money all the way down to the zero level, have essentially become zero return vehicles. They're a place to store your cash. If you're in a government guaranteed money market fund, the fund itself is going to repay your cash, but you're not going to earn anything right now. Right now, there's no return. So the Fed has essentially been pushing people out to assume risk. Well, a lot of individuals have left the money market funds, but they haven't gone to the stock market. They've been moving money largely into bonds, and that to date has been a pretty successful approach because interest rates have come down, and they've come down very dramatically for municipal bonds and corporate bonds, and most dramatically for the weakest of the corporate bonds. So it has been a time where the Fed has tried to promote risk-taking, and so far those that have followed the Fed's direction on that have succeeded because assuming risk over the last 14 months has been a very profitable approach. The people who've been supporting the market in the absence largely of individuals have been institutions. We've seen mostly institutional buying, a lot of hedge fund buying, and a lot of these people are held to very short-term benchmarks. So they can't afford to be out of sync with the markets for very long. And that is a good part of what I think has accounted for being relatively fully invested in common stocks over that time period. One interesting thing to note is that the rise has occurred on